$1 million IRA might sound like a lot of money, but once taxes hit, it could shrink fast and ruin your retirement. In today's video, I'm going to walk you through a tax strategy that could help reduce future surprises and give you more confidence in your retirement income. You know, I've worked with hundreds of retirees over the years, and I've seen one strategy that consistently transforms financial stress into financial clarity. And it's not just about, paying taxes now to save later. It's about knowing exactly how much income you'll have to spend every year. And, to show you, we're going to walk through a real life case study using a real client so that you know exactly how it works. So let's get right into the video. Most people think the hard part is saving enough for retirement. And yes, obviously that's a little difficult, but the reality is, I think the real risk isn't how much you save, it's really how much you're going to keep after taxes. And what I think a lot of people miss as they're accumulating is that every dollar sitting in your traditional IRA or 401k is going to come with a hidden tax bill. And you don't know how much you'll actually get to spend because you don't control the tax rates. And once you hit your 70s, the government is going to start taking money out through required minimum distributions, whether you need that income or not. And if tax rates do go up in the future, those forced withdrawals could cost you a lot more than you expect. And look, over the years, tax rates have changed a lot. And while I have no idea what is going to happen to tax rates in the future, the reality is Congress has the ability to change taxes. We're in a ton of debt in the United States, and somebody's going to have to pay for all of this. And I think it causes a lot of uncertainty around retirement planning, right? Consistently, I think the two biggest issues I come up against with retirees are, is Social Security going to be there? And then the whole tax rate issue. Now, the Republicans have just passed the one big, beautiful bill. And so that locks in reduced rates for now, which generally speaking, for most people is a good thing. And it does at least give us some clarity for the future. But at some point, if the deficit keeps exploding, we're going to go off a cliff and somebody has to pay for this somehow. And austerity isn't really a thing that Congress does well, right? And so, you have to think they probably will increase taxes at some point. And it leaves a lot of retirees sitting here wondering okay, how much of my savings am I actually going to be able to spend? What are tax rates going to look like in 10 years? And then will I end up in a higher bracket than I am in now? And, some people really will. I think the biggest problem with unpredictable taxes in retirement is that they make it nearly impossible to know what your real income is going to be. And so, look, you might have a 7-figure plus balance in your IRA, but without knowing how much you're going to lose to future taxes, how do you decide how much is really safe to spend? And then once RMDs kick in, they can push you into a higher tax bracket. And, an issue that I increasingly see is people that are pushed into higher IRMA brackets and they have to pay more for Medicare. And that can really be like thousands of extra dollars a year. And what I end up seeing happening is that people end up making one of two bad choices. Number one, they either spend too little and live more frugally than they need to, or they overspend early thinking they have more flexibility than they really do, and risk running short later. And that's why I think having a tax strategy is a really smart financial move. So what exactly is the strategy here? Well, I'm sure many of you have heard of Roth conversions, right? So let me first, if you're not familiar with that term, let me explain a little bit about it. So at its core, a Roth conversion simply means moving money from a traditional IRA or 401k that was pre-tax, meaning you haven't paid federal or state taxes on that money yet, so you save taxes on the way in. You take money from there and then you pay taxes now and you put that into a Roth. And once it's in a Roth, you're never going to have to pay taxes on that money again. Now, the key to doing this here is converting during low income years. Typically, that's between retirement and when your required minimum distributions kick in. So there's this critical window of time when you have to do this Roth conversion strategy. So if you're a really high earner and you're, paying 32% or above in marginal taxes, you almost certainly want to save pre-tax as much as you can. And then hopefully you can retire in your early 60s. You got plenty of time to enact this Roth conversion strategy. So, maybe you saved 32% on the way in, but maybe on the way out in these low income years, you're in the 12% bracket, or maybe you're in the 24% bracket. But even that 8%, that's free money right there. Even if you aren't actually in a different tax bracket, but maybe just the same tax bracket, the reality is doing these Roth conversions in that critical window there could still pan out. Let's say if you're in the same tax bracket. And the reason is because for a lot of people, those RMDs are so big that they're beyond what they would have spent anyway. And that creates what's called tax drag. So you don't even have to necessarily be in a lower tax bracket. Now, in addition to converting while you're in a lower tax bracket at that critical stage, in addition to converting when you're in that critical window, we're also going to discuss a couple of strategies that can really turbocharge how much you can get into a tax-free account later on in the video. But ultimately, what you're trying to do is you're trying to lock in today's tax rates, which are historically low, okay? And then number two, you're transforming tax-deferred accounts into tax-free income later, right? Which is gonna give you so much more control and clarity and fewer surprises later on. And you're gonna be so much less susceptible to whatever tax law changes may come down the pike. And what's gonna happen is that when you know exactly how much tax-free income you'll have available in retirement, your spending decisions are gonna be so much easier. You're not guessing, you're not gonna have to adjust your lifestyle every time tax policy shifts. And, it's really going to help you plan with more confidence. And because Roth accounts don't have required minimum distributions, you're no longer going to be forced to pull money out and then push yourself into a higher tax bracket when you don't need the income. So not only does it eliminate a major source of retirement stress, but it's also going to do something else. It's going to, keep parts of your financial life more stable, right? Tax-free withdrawals that don't count towards Social Security taxation or Medicare premium brackets. And, that means you can protect more of your benefits and avoid surprise cost increases. So here in a second, we're going to go through the case study, and then we'll outline exactly how to proceed with a strategy like this. But, now that you understand how strategic Roth conversions create retirement clarity, fill out the questionnaire in the description, and I'll send you a free video analyzing your specific situation, and I'll show you how you can optimize your retirement plan as a whole. But now back to the video, let me show you a real-life example of how this strategy plays out in practice. So this is an actual client that I'm working with right now. She's right on the edge of retirement. And like a lot of people, the vast majority of her savings are in pre-tax accounts. So together, traditional IRA and 401k are a little bit more than $2 million. She's got about 80 grand in a Roth 401k, and then there's also an HSA with, maybe like 50 grand in it. But otherwise, nearly all of her retirement money is going to be taxable when she starts taking it out. Something else in play for her is that there's some real estate that's under contract for sale right now. And so that will also factor into the plan. I'm going to show you, how that works. But now take a look at this chart. So you can see right now, this is federal marginal brackets. And so this is considering if we don't do any kind of Roth conversion at all. So she's up in the 35% tax bracket there. And you can see when she retires, that drops precipitously and she's going to be in the 12% tax bracket. And you've got that whole window. And now she's at the age where she won't have to start taking required minimum distributions until age 75. And so this is going to depend on when you were born. Some people who are a little bit older, they're going to have to take it nowadays at 73, but she gets to extend it a little. So look at what happens after age 75. It skyrockets. I think she's up in the 32% bracket there. And then in her 80s, because RMDs continue to grow and so on, she's going to be back up in the 35% tax bracket. As we talked about earlier, however, the biggest issue isn't necessarily knowing that you have to pay taxes, but not knowing how much taxes are actually going to be then. I mean, think about it, right? Like, she's already going to be in a really high tax bracket at that time. And these are the kind of people that are going to be the perfect target to go after if they have to raise tax rates. And so she might not even be able to count on a 32% or 35% tax bracket, but maybe it's 5 or 6% higher. And, when you think about those kind of withdrawals, that's thousands and thousands of dollars every year. And by the way, I mean, that's literally just a reduced lifestyle for her and a reduced legacy, which is something that she actually cares about. Now here, I mean, this is the chart, same thing, but looking at the effective rate, meaning like what's her average across all sources, not just her marginal bracket, but, same exact pattern here. It drops precipitously in these years where you've got low earnings, and then it's going to jump right back up to where it was, prior to her retirement when she's actually, a relatively high earner. Now, here's where it really starts to come together. So once she retires, we're going to implement a multi-year Roth conversion plan. And the goal is going to be to keep her in the 24% marginal bracket and not go over that. So in the first few years for her, what that means is converting about $120,000. And then it kind of jumps up close to $200,000 per year after that. And now look at this chart. It's completely different. So now she went from the 35% bracket, you go down to 24, and notice like that's very consistent until we stop doing these Roth conversions. But then what happens is exactly what we want to see. It drops precipitously down later on and stays very consistent. What you see down there, later on in her 70s and so on, the taxes, that's because she has Social Security and a pension. And so no matter what, she's going to have to pay some taxes there. And, you don't really know what's going to happen. But that amount is so much lower than when it was combined with the RMDs, which was going to jump her up into the 32% tax bracket. And so, no matter what they do with rates, the kind of income she's going to have from Social Security and pension is definitely going to be lower. And, we don't know where that goes, but I mean, I doubt that they're going to jump her up 20%, and so the reality is once she gets out later, we're going to be able to withdraw all tax-free income from her Roth accounts, and she's not going to have to worry about paying more for IRMA or, reducing her lifestyle or, heaven forbid, not being able to afford an assisted living center that she wants to. And, as I said earlier, I mean, the other big benefit is now this is actually going to leave her with a much, much larger legacy. She's not going to have to take RMDs. And then when her son inherits the money, that's also going to be tax-free. And yeah, I mean, your heirs are going to have to, take RMDs, but there's not going to be any taxes on that. So they can just put that money right into an investable account after they take RMDs. And so it's really a way for you to stretch out that tax efficiency for your heirs. And I mean, I'll show you this final chart here. I mean, look at this. So, over the course of time, you're talking about leaving her son with $3 million extra in tax adjusted assets. And really, I mean, it all boils down to her paying like $2.5 million less in taxes than she would have otherwise. So now I hope you can see the transformative impact of having a strategic Roth conversion plan in place. But that's just one piece, right? I think you also need to understand that the implementation window, it requires immediate attention, because once you get outside of that window, it's going to be too late to do all of this. So for most retirees, the opportunity to do Roth conversions at the lowest possible tax cost isn't going to last forever. And that sweet spot, like I said earlier, is usually the period between retirement and when RMDs kick in, which is either going to be 73 or 75, depending on when you were born. During this window, your income is often going to be lower. That pattern I just showed you is quite normal for a lot of early retirees, and that's going to give you more flexibility to convert funds at lower tax rates. Now, if you wait too long, you're going to miss out on time to compound. And I mean, look, if you're 75 and you're waiting now to do Roth conversions, the reality is you're going to have to pay some taxes up front, but it might take 10 years or so before you've overcome the cost of paying those taxes up front. So the runway just simply, isn't going to be long enough. So this is something that ideally you start as soon as you retire. There's also risk of tax law changes. And so, that's another reason why this is a critical thing to start doing now. Congress has already floated proposals that would restrict Roth conversions for high earners. And, future changes might narrow this or take away the opportunity completely. And so, that is why this conversion window, however long it lasts, is such a big deal, right? Taking action early can lead to significantly better outcomes, both in retirement and, honestly, for the next generation. So now we'll talk about why conditions are unusually favorable for Roth conversions right now. So one, tax rates, as we mentioned earlier, are historically low, but it's hard to believe that they could possibly last like this forever. The national debt is growing, and eventually, like I said, somebody's going to have to pay for it. Hopefully it isn't you or me, but come on. It's probably going to be high earners, right? But even beyond high earners, depending on whose forecast you look at, there might not be enough of them. And so it might have to go down even into lower tax brackets if they really want to get serious about paying down the debt and so on. Now, beyond that, just the tax laws in general are really favorable, but they may actually take the ability to do these Roth conversions and backdoor Roths and so on away from you, especially based on your income. So that means if you're worried about that happening, now is a great time to start. And so here's a couple of tactical ways to approach this where, you might actually be able to convert more than you normally would. So there's, a couple things to think through. One is market volatility, right? So when markets are really, really volatile and they go down, maybe 20% or so, that's a great time to do Roth conversion. So what you want to do is you want to convert the Roth at kind of a low market point. The money goes into the Roth, maybe it's 30,000, 50,000, 100,000, whatever it is, and markets recover. And, generally speaking, you're probably going to be more aggressive over in the Roth, and it's going to depend on your situation. But, as the markets recover, that's a great way. You took something that was maybe worth 50, and then all of a sudden in a few months, it's worth $80,000. So number one, you want to take advantage of opportunities like that. Because look, you're paying on a low tax number and you're locking in all the future rebound inside of the Roth, which is completely tax-free. Now, another strategy that I think is pretty good here, especially for people with substantial wealth, and I think they can take a little bit more risk on what they're doing. You can take private investments inside of an IRA. I'm going to give you a common example that is like an oil and gas development play. There are tons of tax benefits to these, and one of those is that they take valuation discounts, and they also have discounts for depletion and things like that. And so what happens is you might take $100,000, you invest that into your IRA, right? So that's the pre-tax account. And you get all of these discounts, and this is legal, and there's tons of tax opinions on this and so on. And by the way, nothing I ever give in this video should be taken as tax advice. You guys need to do your own research, and there's a ton of risk on oil and gas, and there's a lot of shady partners out there. So be very careful what you do. But I think it's a great example, and if you do find a sponsor that does a good job, this is a way to really turbocharge your Roth conversion. So maybe you invest $100,000 in this oil and gas play this year. You're going to get all of these valuation discounts, liquidity discounts, minority interest, and so on. And generally what happens is you'll take a discount, very soon of somewhere in the ballpark of 50%. So you took $100,000, all of a sudden it looks like $50,000 on paper, but it's still the same exact interest in these oil wells. You convert at that time the $50,000, you put that over into your Roth. Then what happens is you get these payouts. And usually these things, you get the bulk of them within the first few years, and then they kind of trail off until, the wells are depleted. But what happens is, you might have invested 100 grand and probably, if you're with a good sponsor and things work out, you're going to get 150 to 180 to maybe $200,000 of cash flow back over the years. That's a great trade, guys, right? Because you paid taxes on the 50 grand, not the 100 when you took it out, and you're going to get back, maybe 150, maybe $200,000 back on that. And so you keep staggering these over the years. Now, you got to be very careful here, because if you have a modest net worth, let's say like $1 million, you probably shouldn't be putting 100 grand in these kind of projects every year, because heaven forbid they go bad. I mean, you don't want a bunch of oil and gas wells out there. It's going to ruin your net worth. So this works out really well when you start to get, maybe $5 million plus. Then you can really do this on top of a regular Roth conversion strategy and just turbocharge your tax-free income. Now, again, you need to get your own tax advice and do your own investment research. And I don't want to advocate any specific investment. And full disclosure, I am all about liquid, daily tradable investments and having maximum flexibility. But, I also want to keep an open mind. And, for somebody with the right net worth, this might be something that could really work out for you. So now that you've seen how this implementation window creates urgency, let's look at how you can actually implement this advice into your own retirement plan. So how do you figure out, the right Roth conversion strategy for your situation? Well, first, it's going to start with an understanding of your tax brackets, both now and in the future. So you need to look at what tax bracket you're in today and what you're likely to be in once you start drawing Social Security and pension income and hitting RMD age and so on. So I kind of showed you that chart of what that looks like. So you're going to have a budget of your income. You're going to have to know what your Social Security is, pension, and all of your, not a budget of your income, but an expense budget, right? You're going to have a decent idea of what that looks like. So that way you can forecast your taxes. So in the case of the client that I showed you earlier, we knew that her tax rate was going to drop right after retirement and then spike later on. So that middle zone was the perfect time to start converting. But it wasn't only about the tax brackets. You also have to figure out how you're going to pay taxes. And that's something we kind of skipped over earlier. So in her case, we were fortunate because she is selling that real estate. And that real estate sale is going to give her liquidity, and it's going to give her cash that she's going to be able to use to pay the taxes for the Roth conversions. Because remember, if you're taking out 100 grand this year to do a Roth conversion, you're going to owe taxes on that, and it has to come from somewhere. Now, if you're paying the taxes out of the IRA or 401k that you're converting from, it's so much less of an efficient strategy. And in fact, if that's the case, it might not make sense. So, in this step, it's critical if you still have a little runway before you retire and the bulk of your savings is in pre-tax. Now you've got a few years to start shifting savings over to a regular taxable account. But really, coordination here is key. And that's when you really have to take a systematic approach. Now, getting the timing right is obviously really important, but if you want to get the most out of the Roth conversion strategy, you definitely need to handle the details correctly too. And one critical piece is going to be account segregation. So you need to keep your pre-tax and your after-tax and your Roth assets in clearly separated accounts. This is going to prevent something called pro rata taxation, and that can turn what you thought was a clean conversion into a mess where part of it is going to get taxed unexpectedly. So clean separation is going to help keep the math simple and the tax treatment accurate. Now, another key factor is timing your conversions relative to other income. So if you have a big income event coming, like, you want to sell a business, you're selling some major real estate, like a rental or something, or even starting Social Security, you want to be aware of how this affects your taxable income for the year. Because, look, that timing could mean the difference between paying 22% or 32%. And then all of this is only going to work if you take the time to map it out by year. So a multi-year conversion schedule is going to let you fill up each bracket intentionally, and you're going to be able to maintain control over your tax exposure and avoid surprises. And this way, you're not reacting to tax bills, in effect, you're kind of shaping them. So you get this multi-year roadmap out, and then every year, generally what I do is in about November or early December, you've got a good grip on your taxable income. Surprises happen, right? And you might get capital gains or whatever. And then you know pretty much exactly how much to convert at the end of that year. And so when you put all of these elements together, okay, a thoughtful tax bracket analysis, a plan for covering the taxes, clean account structure, careful timing, and a clear multi-year plan, you're going to create real tax certainty. And look, that certainty is going to give you peace of mind that so many retirees are looking for. And now that you understand how strategic Roth conversions can transform retirement uncertainty into predictable, tax-efficient income, you can implement this powerful strategy to create the financial clarity that eliminates retirement anxiety. And if you want to discover exactly how to implement strategic Roth conversions for your specific situation, fill out the questionnaire in the description below, and I'll send you a video analyzing your specific situation and showing you how to create true retirement security. Thanks for watching, and I'll see you in the next one.